Hello listeners and welcome to Plugged In, the energy news podcast from Montel, where we bring you the latest news, issues and changes happening in the energy sector. Winter is coming. And if it's cold, we've got a problem. That's the message from gas traders this week. A week where the EU said it would ban Russian LNG imports from the 1st of January 2027. With European storage levels notably lower than a year ago, experts are predicting that gas prices could jump more than 30% if Europe is hit with very cold temperatures this winter. The previous 3 years have seen relatively mild winters, but is Europe prepared for a season of cold snaps? In this episode, I'll be speaking to research principal Wayne Bryan at the London Stock Exchange Group. But first, I'm joined by Montel's Deputy Editor-in-Chief, Laurence Walker. Welcome back to the podcast, Laurie.
Hello, Richard.
So let's start with storage levels. Why are they so low in Europe this year compared to last?
Well, certainly the EU has relaxed its targets this year. So whereas last year you had to reach the 90% by winter, this year they've relaxed that. So you only have to reach that 90% target between the 1st of October and the 1st of December. So there isn't that kind of rush to get gas into storage like we had last year, and people can kind of do it at their own pace. So it's not necessarily a sign of a shortage as such. It's just a different way of building up the stocks.
I think that's a very important observation there. It's not no panic stations here whatsoever. I think that's important to reassure people with that. But what in more general terms, Laurie, what are the expectations for the coming winter in terms of supply and demand?
Well, certainly, I think from now, the market's looking pretty relaxed, pretty comfortable. Certainly, we have plenty of LNG coming in. We have plenty of gas coming from Norway. And in terms of demand, it's not as strong as it could be. We haven't had really seriously cold weather yet. The projections are not terribly cold for the time being. There's perhaps some cold snaps on the horizon, but no prolonged periods of cold weather which would really drive up demand and cause problems. So as things are looking now, I'd say they're looking pretty comfortable.
And how has the market actually priced in the coming winter then?
If you look at prices along the curve, it's very, very flat. We're talking, 32 euros a megawatt hour pretty much each month into April. So, you could say people are poised, waiting for something to happen possibly, and they will react, and you may see more, you could see price spikes, obviously, as you could at any winter. But certainly at this stage, things are looking fairly positive from a supply viewpoint. I don't think people are too concerned yet, at least.
Thanks very much, Laurie. So, what are gas traders going to have to contend with over the coming months? I'm pleased to be joined by Wayne Bryan, Research Principal at the London Stock Exchange Group. Welcome back to the Plugged In podcast, Wayne.
I know. Good afternoon. It's been a while. Nice to see you all.
Yeah, great to have you back, Wayne. Now, I just want to start with the sort of news out of Brussels. I don't know what's more surprising, the fact that the EU will ban Russian LNG imports from the 1st of January 2027, a year earlier than previous planned, or that Europe is still sourcing about 15% of its gas from Russia. What do you think, Wayne? What's the impact of the ban on Russian LNG from the 1st of January 2027?
Well, I think firstly the ban has to happen. I think if we take everything into consideration, I believe this ban is something that needs to happen for many reasons that we all know. The only problem with this ban is, again, the over-reliance now on another source of supply, which is America. So that's also, you sort of jump in out of bed with Russia and sort of into bed with the US. Not that it's got the same sort of geopolitical risks as we've seen from Russia over recent years. So I think the ban, and again, this has come from a lot of pressure, not only from America. I think Donald Trump put a lot of pressure on the EU, as well as it comes from internally. We see all the sort of noise in the news around Europe. We've seen what's happening in Ukraine at the moment. A lot of the attacks are really targeting the sort of energy infrastructure and ahead of the sort of heating season. So I think that the ban sort of has to happen, really. And the second part of your question was?
What do you think the impact will be?
Well, you can look at the curve. The curve doesn't see it as a huge impact. I think what will happen is, of course, we've got a lot of alternative supply sources coming online LNG-wise. And I think if you look at over the next by the end of the decade, I think US LNG export capacity doubles. So again, I think for me, the main thing is we're just moving from over-reliance on one supplier to another, like the pipe gas situation, but due to the current sort of global market and sort of not only from a supply-demand sort of gas fundamental perspective, but also from sort of economic perspective, I think the sort of risks of people talk about shortages, etc., are quite minimal. And I think, as always, the European gas market always adjusts and finds what it needs, whether that comes through price or demand side reductions, we will get there. So I think overall, A, it's a good thing, and B, I think we're in a much better position to cope than we were, say, a couple of years ago when the sudden halt in Russian gas pipeline imports obviously saw, prices hit the sort of the heady days of 330 euros per megawatt hour.
Absolutely. Now, let's move on to prices.
Yeah.
Where have they been in the past few months, and what have been the main drivers?
Pretty range bound, to be honest. We've had a few small spikes, but if you look at the sort of summer, you saw a lot of the geopolitical instability in June. Iran, Israel, Russia, Ukraine, Qatari issues. And then, since then, sort of July, August, September, couple of the odd little spikes here and there, but mostly pretty range bound. In fact, I was looking at the TTF and day ahead and front month over the last couple of days, and if you just take it back a month, I think the day ahead is trading in sort of less than €3 range, and the month ahead even tighter, about 2.5. So that goes to show you where the market is, and we're actually below where we were last year. In some instances, we've been 30% lower than last year, despite entering the start of the season with obviously less storages. And again, that kind of shows you the sort of confidence in the market. However, a lot of risk still remains, and I think some of the drivers we've seen recently, again, low renewable generation. But if you look at renewable generation for the week coming, super strong. The UK here today, as you know, is very windy, and that's expected to continue. So a little bit of a bit of upside from that. We've had a few maintenances in Germany that's impacted LNG send out. Norwegian maintenance has been a little bit stronger than we expected. So there's been a few little things, but nothing really to sort of send the market into sort of panic or overdrive, shall we say. And if we look forward, I think for us, looking over the sort of next week and into next month, we're releasing one of our monthly reports today. We expect prices to slight increase based on current prices today, but nothing too bullish based on the sort of supply demand factors. And it looks like we'll be returning more to withdrawals next month as well. Still quite a lot of uncertainty over weather. Some of the longer range forecasts, some people haven't got much confidence in them. Some of the signals point to quite mild. If you look at the EC46 at the moment, it's pretty nice until December. But again, then we get this period of uncertainty, December, Jan, Feb, where at the moment we're still not sure where that sort of residential or heating demand will be.
Sure. Well, I mean, for those listeners who may not be following the gas market on the day-to-day, or as much kind of focus on detail as you do, but where are we? What are the current prices, and where do you expect them to be in the coming months? If you say the TTF, the Dutch hub.
Well, TTF day ahead, if you look now, is trading around the sort of 31, 32 mark. I think it's 32.2 today. We see that maybe slightly higher next month, but nothing more than 33, based on looking at the fundamental analysis that we've done looking forward for the next month.
And you said, we just for those listeners out there, we are recording this on Thursday
Correct.
afternoon, so that's where the report comes out from LSEG. No, is the market? So it appears to me that the market is
pretty relaxed.
Relaxed. It's not pricing in a cold winter.
No, but we know that can shift pretty quickly. And I think the market now is in sort of wait and see mode. You've seen this indicative of this sort of range bound situation we're seeing. We're waiting for the next surprise, really. And as we always speak about, there's always something around the corner, whether it's from a supply perspective or a demand side or a geopolitical side with the trade wars, tariffs, etc. Trump, China. I mean, there's quite a lot going on at the moment in terms of geopolitics. But at the moment, not much of that is filtering into the gas market. But it can do.
But in general, in terms of supply, are we safe? Are we out the woods? Is there kind of is it maybe a little bit dangerous to say there's an abundance of supply, but certainly less nervousness in the market than there was, say, a year or two ago?
Yeah, a lot less nervous. Of course, things can happen and prices can spike. But as I mentioned earlier, if we look at where we are this year compared to last year, some 30% difference in prices, depending on what exact day. But we've seen that fluctuation compared to last year throughout October. So for me, that goes to show you the market is in a better place. There's several reasons for that. Of course, LNG import capacity has massively grown in the past 12 months. We've seen more renewables and French nuclear is super high at the moment. I think it's forecast over 50 sort of next month. So there's a combination of factors. And last year we were quite concerned about the loss of Russian transit from January the 1st. This year we know that's not going to happen. So we already know what to expect in that respect as well. So like I said, there's definitely still risk. But if you look at the winter now and sort of zoom out, for the whole winter, I think we revised our end of season storage for Northwest Europe. And looking at our scenarios, even in our cold scenario where stocks get severely depleted, looking at what's available next summer, we can quite easily replenish storages to the 90% level by September. I think in our sort of mild scenario, then we could fill the storages a lot earlier. So overall, for us, now the market looks, it looks how it's pricing at the moment and how it's sort of moving is pretty flat, and we're just waiting really for something sort of to happen. And again, our storages, we still see comfortable situation. If supply is where we expect it, demand is where we expect it. And even in the three different scenarios, we still manage to fill these storages. And we see it now about 74% by the end of November. And again, we're going to fall short of the 90% for total EU, but we have it at 74%. And last year it was 85%, so an 11 percentage point difference.
But of course, no one wants something major to happen to break us out of this range, in a sense, Wayne. So hope, fingers crossed. But let's talk about on the demand side, what's happening in Asia. For example, is Chinese gas use slowing? What's happening in northeastern parts of the Asian continent?
Well, China's got several situations actually in China. I think one of the first thing we've seen in China is the gas use is slowing. You've got LNG truck prices are lower, which obviously impacts. Also as well, higher global prices mean you favour the local market. Gas production is rising. Gas imports via the power of Siberia are up to 31 BCM. Renewables have grown. And of course, don't forget, they're still taking LNG from sanctioned places as well. That's another story. But overall, I think if you look at China, we see perhaps this year a slight increase in Chinese demand, maybe 4 or 5%. Some of that is linked to some potential industrial rebounds as well. So China, again, it's a market we have to monitor for this winter, and that will continue to be the case. But so far, a few percent upside compared to last year.
And obviously, if there were to be, escalation in the trade war and the tariff situation, then that could have a big impact here, right?
Correct. And again, tariffs are a concern not only for China, but for the rest of us. For example, if you look and if you saw German industrial production plunge to 2005 levels, if you discount COVID-19 low and the global financial crisis in 2008, German industrial production is now at 2005 levels. Some of that was brought on by a big drop in car production, which really slumped. And again, some of the data was slightly skewed by closures because of holidays of the car plants. But if you look at the car industry and the industrial sector as a whole, it's really struggling. We've seen, and again, it's another example of tariffs, the import duties on cars have impacted German exports to the US market. And China used to take a lot of German, not only cars, but goods in general. That market has also suffered. And of course, higher tariffs on China have seen China flood Europe with some of their goods that would typically have gone the other way. So more competition there. So if you look at that side of demand, it's not looking great on an industrial basis. And chemical production, of course, utilization has fallen. We're seeing rising contracts being signed for imported ammonia, which again is another sort of structural change in the sort of gas market on an industrial basis. Looking at residential, we've seen the last 6 months rolling average of demand destruction larger than the EU mandated. Remember the 15% they came out. If you look at Northwest Europe, it's about 19% demand destruction rolling 6 month average. So that goes to show on the residential side, a lot of that is permanent. Again, energy saving initiatives. I've highlighted before that people change their attitudes to heating their homes, etc. If you look at Germany for October, so far it's 20% in terms of what we'd expect in terms of demand on these current temperatures. So
it's 20% down, or
what we'd expect. So demand destruction, Northwest Europe as a whole is 19. Germany isolated is about 20.
In residential or residential?
This is residential. LDZ demand destruction I'm talking about. So purely for the domestic heating market.
That's very, very interesting. I mean, so
demand isn't doing great, to be honest.
No.
Industrial demand in general, France is, the big powerhouses are struggling. I think Netherlands is the one with the bright spark at the moment. But
are there any industries where there is an upturn or there is a bright spot anywhere? Or is it all pretty much slumping?
There's a little bit of bright spot in sort of manufacturing, but again, if you look at all the metrics, we're still not in expansion territory in Germany yet. And of course, if you look at the German market itself, look at the GDP forecast, they're quite weak over the next 3 years. And they're hoping, if you read what I think one of the German finance ministers, they're hoping a lot of this uptick in demand comes from the domestic market. And a lot of it's due to stimulus, obviously government stimulus. So again, uncertain, not just again for Germany, but if you look at across the Northwest Europe, there's not many economies. Maybe Spain's doing okay, and the Netherlands, as I mentioned, but again, not great. And of course, renewables. We've seen stronger capacity increase. I think Germany's got an extra 6 gig of solar this winter. So we're expecting a bit lower gas for power this winter because last year we had that big Duncan Flout episode, which really sort of not only does it sort of emphasize intermittency in renewables, but also into gas. We need gas. We still need gas. Gas is baseload. Gas is still needed in times of these intermittency, despite how much renewables we pile onto the grid. You saw that in Spain this summer. And then Spanish gas for power demand rocketed. And again, that sort of an alarm bell started ringing. I was in Madrid last week talking with some people about that. And gas, they're building some new plants.
And so is Germany as well. Germany's got massive plans. Yeah. It's
you're in the gas business.
Yeah, it's
not as doom and gloom as some may have you say. And so I think gas still has a bright future. And look at all the FIDs and all the projects coming online now. There's a lot of talk if it falls to $6, what's going to happen, and is it going to be oversupply? But we need to get there first, I think.
But has Europe built too many floating LNG terminals, or what's that? Is there now, in terms of the supply coming in, are all these terminals going to be used, or is that what's the situation there, Wayne?
Well, if you look at the moment, I think the actual capacity is double the imports. So we've built, I think, 12 terminals, 6 or so projects, and don't forget Germany's really done well. Germany's got 4 on the go now, so FSI. So they
the floating units, exactly.
They really ramped up. So, but again, this is the risk so far this year. Around 58% of imports of LNG have come from the US, and that's only going to increase. And it's only going to increase, and we're up about 60% year on year. So.
Do you think that's a worrying trend there? That you mentioned that at the start, that we're swapping reliance on one country for hopping out of bed with one and then into bed with another. Is this a concern? Do you think?
It concerns me a little, not because from a reliability aspect, but from a sort of regulatory and tariff wars. And we've seen, we've spoke about Donald Trump several times, you and I, over the years. And what we've seen playing out so far is sort of exactly what we expected. Just random statements, random tariffs, chickening out, taco as some people call him, rolling back one day, re-implementing the next day. One day it's, he's good friends with President Xi. Next day he's slapping tariffs on them. Then you've got the India situation. So there's a lot. The rare earth thing for me could really escalate tensions. Trump's very keen on these rare earths, and China now looking to put sort of almost export duty, so you can't really sell it on, which is also, so for me, that's the only concern, is a breakdown in relations over one could lead to, a ramp up in tariffs on another. But I think the US are aware, of course, they can sell their LNG, but they do need Europe, and they would rather that Europe spend their money with them than on the Russian LNG, which again was what we were talking about earlier. But for me, it does raise some concerns. But I think overall the relationship is quite good. But it does, you put your eggs in one basket like that with Mr. Trump, he sort of, I wouldn't say got you over a barrel, but he may use that. I've seen that sort of tactic across his sort of diplomatic or sort of, his meetings, etc., or his statements where, he likes to have the upper hand, and then then he could sort of ride roughshod if he wishes. So yeah, it's definitely a risk, but I think overall it's good for the security of supply, and I think that's something that recently, if you look at the sort of energy transition trilemma, sustainability, security, but affordability and security supply now seem to be well ahead of sustainability in terms of the merit order. And that was something, again, I was talking about last week in Spain, and a lot of people have that opinion now that it's sort of taking a back seat. Let's just get affordability, let's just get security of supply. Sustainability concerns still there, valid concerns, but we need to make sure, first and foremost, we satisfy.
I mean, that's the kind of general trend, isn't it? I think in a lot of kind of, you're seeing it in annual reports from companies, from, the ESG, the sustainability and governance is kind of falling away a bit, and the focus is very much on other aspects.
Exactly.
The affordability, the profitability,
exactly.
and even, back to fossil fuels. But Wayne, do you think, the US is also becoming more aggressive in marketing its LNG?
Yes, it seems to be the case. A lot of new FIDs, and also just putting demands on other countries about where they should be buying their gas from tells you as well that they're quite aggressive. And again, all these new additions, new capacity additions, new plants, new trains, all feed into Donald Trump's freedom gas. He wants the US to be the biggest exporter of everything, if you listen to his communications. So it's quite an aggressive strategy, but it's based on continents that need gas. So why not be aggressive if you've got the volumes and you've obviously got the cheap domestic market, massive discount to the rest of Europe at the moment. That may change over the coming years as all the new waves of supply come online. So
And which European countries are going to be most reliant on LNG imports? Where's the biggest reliance? We saw, the countries that were most reliant on piped gas, but where's the import dependency? Where's that at its highest?
Sorry, as in
which countries?
Well, we know France, Belgium have imported large amounts
of Russian LNG.
Sorry, LNG,
LNG.
So from that side, there's definitely some more demand there. But if you look at the rest of Europe, then most of it, like you said, Qatar, US, these are the main suppliers to Europe, and I think the countries that are overexposed to Russian gas will have alternatives. But now you've got the situation with Japan, which they're being urged to sort of scale back on Russian LNG, but they've got quite a lot of long-term contracts.
But I wasn't just thinking Russian LNG, more LNG in general, Wayne, so from Qatari, from the US, it's France, Belgium, Spain.
Northwest Europe.
Northwest Europe
as a whole. Yeah. We need that LNG, not only for supply, but also, we need to refill these storages. And again, that loss of that flexibility from Russia means that we're going to continue across Northwest Europe to need these. And then now maybe even Ukraine might need some additional volumes now based on what's been happening there.
That leads me on to my next question, Wayne.
Segue.
A nice little link there. So we've seen Russia continue to target Ukraine's energy infrastructure this month, and predictions that Ukraine will be relying on Europe for 25% more gas this winter. Yeah. What impact will that have, or how do you see that playing out, and what kind of impact could it have on Europe more widely?
Well, they've said they want to purchase, I think it's up to 2 billion or 30% increase compared to last winter. But if you're looking at the current prices, around the 2 billion, you're looking around 4.5 to 5 BCM. Now that would help, and that would be close to the 30% increase they need. So that would help. And of course, what would happen then is sort of you need to get them flows into Ukraine, and currently they're coming via Poland, Slovakia and Hungary around 250 gigawatt hours per day. If this does transpire, this additional I think Norway as well today chipped in 140 or so million towards that fund, which was nice. So I think what you would need then, that increase we mentioned 30% is what they're talking about. That would take it to about 325 gigawatt hours, which if you push that all the way through to the end of March from say the start of November, that would bring you up nicely to that sort of level. So what it would do is just, reroute some of the flows and might add a little bit, but not a massive amount of upside pressure. You've seen the market hasn't really reacted. Even when it was announced, the market hasn't really reacted that much to that news. Just a slight little reconfiguration of some of the flows, but we don't see it as a bullish factor. unless that number changes, of course, which we all know. Again, that's obviously another possibility. But again, they need to get it into the country, and there's not that many routes.
Of course, and there's toing and froing about peace deals, etc.
Yeah.
And do you think is that likely to happen before Christmas? And what kind of impact could that have here? That could throw another new spanner into the works, couldn't it?
I certainly, looking at the recent meetings, communications, I think they cancelled this meeting now in Budapest.
Trump and Putin.
Trump and Putin, sorry. Yeah, that it's meant to be Lavrov first and Rubio, and then that got cancelled as well. Yeah. So, and if you look at the sort of ramp up in attacks over recent months on the Ukrainian energy infrastructure, and also from Ukraine on Russia's infrastructure, which has taken a quite significant sort of damage over the last few months. It's really impacted. You look at the local diesel prices, etc., and shortages. And I think a peace deal doesn't look that much on the cards at the moment. I know Trump posted something yesterday on Truth saying, ceasefire immediately, etc. But there doesn't seem to be any will, really. I think Zelensky's been making these trips and trying to get these talks started to perhaps start with a ceasefire, and then you start talking about the rest of it. But it still looks quite a long way away. And this is, we're now, 2022 this started? So all started building up in sort of this time of year in 2021 with the troops at the border, etc. So really 4 years on. And we haven't got any closer. And it's this constant drone missile exchange.
Yeah.
So
and it does take two to tango, doesn't it?
It takes two to tango. It doesn't seem to me, seems Putin meetings are stalling. It's always about stalling. I think the latest offer for a meeting was because the US raised the spectre of Tomahawk missiles, which would really allow Ukraine to target most things they want across Russia. So that happened, and then the meetings got cancelled. So, but now you see Trump is getting more irate. But something needs to happen. And I think as well, if you look at America's sort of policy, not only on that side where they've been failing with this ceasefire, but also if you look at these tariff sanctions, where's the implementation of the sanctions on Arctic 2 LNG? China's taking these cargoes. I've heard nothing from America, but I thought these are meant to be sanctioned. Where's the implementation of that? So that's another thing that doesn't quite strike well with me, to be honest, when you have these sanctions in play and there's a blatant proof of these cargoes arriving, but we've seen nothing.
From Russia to China.
Yeah,
exactly.
We've seen nothing from the US.
I mean, that adds to the global supply as well, though, doesn't it? In a sense,
it does.
Otherwise it would be a lot tighter.
Yeah, correct, yeah.
Just a final question, Wayne. I think we could talk for hours as we do anyway, but often. But do you think there's enough flexibility and cooperation between countries in Europe to keep the gas flowing?
Yeah. I think so. Well, we have these agreements with, security of supply and cross-border flows. So I think we are better. We've extended, obviously, I mentioned the LNG recapacitation. We've had measures to help curb price movements and volatility, or not the price cap I'm talking about. So we've had several measures, the demand destruction or demand reduction. So I think Europe, and if you look at sort of margins, peak demand, peak supply, there's still some wiggle room. I don't think we're ever going to see a situation where the lights go off, as we know. But I think Europe has put itself, again, despite the loss of significant amounts of gas, I think the transition has been pretty remarkable in terms of how we've adjusted and managed to bring prices back down to where they are. Still above, obviously, pre-crisis levels, but we've brought them down significantly. We really
to
have.
Manageable levels, absolutely.
Yeah. And so you see a lot of the hub prices now quite converge, which shows you, again, of course, your typical, like your Italy's now is a little bit higher, but again, that shows, again, there's, a bit more harmony in Europe at the moment. But again, we still see a lot of things that can change over this, not only the winter, but over the next 12 months. There's a lot we've just spoke about with LNG bans and ongoing wars and tariffs, and the picture could be a lot different if we have this conversation in March.
Yeah. A lot could change, Wayne, but, maybe to summarize, we're in a much better place now, maybe in a fairly good place compared to where we could have been or where we were a couple of years ago. So
exactly, and that's what we had a webinar title that sort of kind of like you said, like the last dance, but it's the last winter. Really, is this the last tight winter? If it is, look at the prices. They're close to summer prices now. Summer's around €30. We're about 31, 32 now. So big difference to last year.
If anything changes years, Wayne, we'll call on you to give us your expert comments again. Thank you very much for being a guest on the Plugged In podcast.
Thank you.
It's been an excellent and insightful discussion. I hope you agree, listeners. And thank you for tuning in to this episode. Our podcast episodes are released every Friday. For the latest news from Montel, please visit montelnews.com, and you can follow us on LinkedIn, Blue Sky, and other social media channels. See you next time.